I've been asked to throw some light on the contours of insurance industry. Though my comfort level lies in the other industries, but however, I remember when I was advising the IRDA, at that time, and I was also simultaneously heading a management school. OECD had a conference at Delhi where Y.V. Reddy, who was once upon a time my predecessor also when I was at ASCII, C.S. Rao, who was chairman of IRDA, and on behalf of SEBI, on Pratipkar, they were the speakers and I was the moderator. So Dr. Y.V. Reddy and myself, we had a small fight. I'll tell you, I'll start with that fight. Dr. Y.V. Reddy, while talking, told that one retired friend of mine, who was an economist, came to me. It's Y.V. Reddy, not me. Y.V. Reddy came to me and told me that why did you, at that time he had suspended Abhyuday Cooperative Bank. He told, I had put all my money with Abhyuday Cooperative Bank and you have now frozen the bank. What do I do? Then I told, when your wife goes to market, to purchase ladies' fingers, bhindi, she goes to 5 shops before purchasing half a kg of bhindi. You put all your money in one bank without verifying, and there is a lot of clap in the public. It was over. His talk was over. Then I was to moderate, so I told Modi Garu, if you don't mind, I'll offend you a bit. Bhindi is not regulated. There is no stamp on bhindi. So she goes to 5 shops. But these banks are all put a regulatory stamp. And once there is a stamp of Y.V. Reddy, why should we bother to go to 5 other stamps? Each stamp should be equally weighed. And so you can't blame your retired economist friend. And another thing also, economists never retire. So your friend must not have retired. If he has retired, he must not be an economist. So of course, Y.V. Reddy smiled, but later on he told, you should not have talked like this, because after all, I was representing Reserve Bank of India. I am heading Reserve Bank of India. So anyway, what I want to say, that you see, in India, the contours of our financial institutions are determined mostly by the regulators. It doesn't evolve from the grassroots. So there may be many options available. I'll give you another example. When we were in SEBI, there is a Market Development Committee, and in that committee, Mr. Rakesh Mohan was the chairman of that committee. I was a member, so Rakesh Mohan ji told that we don't allow even duplex deposits. State Bank of India made a request, we didn't even allow duplex deposits. And I told, but sir, I had gone to Singapore, they have allowed already multiplex deposits. Duplex deposit means you deposit in one currency and get the coupon in another currency. And multiple series of currencies also is possible. But Rakesh Mohanji told that we have blocked this. I told, sir, why you have blocked like this? I asked him, why have you done this? Now, because bankers are not yet trained to observe this kind of product. I told, sir, they will never be trained if you don't allow them. When they will be trained? How they will be trained? So first allow the product to come and thereafter regulate it. You cannot stop the product and say that they are not trained. Anyway, same is with Indian insurance industry. Insurance industry is highly regulated. Previously, there was a Insurance Act 1938, which was regulating insurance, and insurance was very narrow. Only way insurance was innovating is how many ways they can mis-sell the product. Mis-selling was the only innovation. And IRDA came in 1999, and I had a good fortune. Right from 1999 to 2009, for 10 years, I was advising the initial stages of IRDA. And we had a very small goal at that time in 1999. At that time, India had insurance penetration of India was only 1.1%, whereas global average was about, at that time, 9%. And India was one of the last country to have insurance density. Hardly there was any insurance with anybody. Insurance penetration is how much of insurance is, how much of GDP is explained by insurance. And insurance density, what is the per capita insurance of the Indians. So both India was very poor. So at that time, Rangachari, he took a decision that we will regulate in such a way that let there be some laxity, no problem. We will regulate in such a way that at least there will be 5% penetration of Indian insurance by 2005. He had given himself 6 years time for reaching 5% penetration from 1.1% penetration. Though it was not reached in 2005, I'll tell, he was not an insurer, he was a CBDT man, and he told that, Mishra, we are taking very dangerous risk, maybe all of us may be sacked for this. And but unless we take this kind of risk, there will be no penetration of insurance in India. And I tell you, by 2006, India had 5% penetration of insurance. But you may be happy about that, but still 5% is not even nearer to global average, not even half of global average. But more pathetic thing to come is now. Now insurance penetration of India has come down to 3% from that. Why? Because the next regulators, they decided they will regulate insurance industry, take no risk, and create tough war with Reserve Bank of India, with SEBI. You must have read in newspapers the pathetic story between Harinarayan, IRDA chairman, and Mr. Sinha. In fact, Dave, the top war between them, and in the process, both got curtailment of their product. Dave got curtailment of his intermediary, and this fellow got curtailment of his, what is famously called or infamously called ULIP in insurance, unit linked product in insurance. I'll now come to contour of insurance industry. Now, of course, there are more than 54 insurance companies in India. Informal sector, why I say, can there be informal insurance? Yes, there are a lot of informal insurance company possible despite the IRDA regulation. For example, even IRDA itself didn't know. Once a company came to me when I was director of National Insurance Academy of India, a company came to me and said, sir, we want to regulate ourselves, self-regulate ourselves. Can you advise us? I told, you are an insurance company? Now, yes. Now, how come you are an insurance company? All insurance company must be regulated by IRDA. No, sir, we have got 40,000 policyholders and we are allowed under this law. Then for the first time I knew there are other parallel laws in which insurance company can come up. For example, Seva has got more insurance than some of the small insurance companies. So, some of you might not know, but there can be insurance in informal. For example, PLI and RPLI, there are typical cases of informal insurance at that point of time. Now, of course, they are regulated. Even in non-general insurance sector, ECGC was a typical case of doing insurance without IRDA regulation. Now, all these things have changed after discovery of that CBDT Act, where a CBDT provision where there can be informal insurance. So, insurance regulation is evolving because many things are not known. As I told you, there is a illiteracy among the regulators also and illiteracy among the operators also. So, in insurance sector, we are talking of a banking, non-financial institution insurance. I used to tell insurance regulator and insurance purveyors, 84% of your business is banking. You may ask me why. Just for your information, in insurance, there are two components. One component is called the, for example, life insurance. One component is death risk. The other component is survival risk, which includes maturity refund. Survival risk. Survival risk is basically the banking risk, same as banking risk. So, what is the death risk of India? Of the total corpus, death risk of India is only 14%. I have analyzed the insurance industry for, there was a very rudimentary insurance industry up to 1999, but before 99 it was much less, after 99 it is little more, so 14%. Before 99 it used to be 6%. So, 14% is the death risk That is the only risk that is the insurance risk. Rest of the risk is banking. So insurance, now you are talking of strategically important NBFCs, but Dr. Reddy, of course, based on Basel, he introduced the concept of CP, strategically important financial institutions, and LIC is the biggest CP, even bigger than any of the commercial banks, just for your information, because that depends on asset management, the extent up to which they can have monetary control beyond banking. And CP, LIC is the number one CP of the country now, at this point of time. So, LIC has got a corpus, has got an asset size, which is, the total asset of LIC is bigger than the top 5 banks' assets of the country, for your information. And the life fund is huge. So that's why I remember Dr. Reddy and even Subbarao was lamenting that what we will do, LIC can undo what we do by government dictate, whatever is done. Recently we had a seminar where I was telling the audience that instead of Raghuram Rajanji was lamenting that there is no pass-through, the policy pass-through is very poor. Now a situation has come, there is advance pass-through. People are passing through before RBI could open its lip. They read the lip and they pass through. And that has become a marketing device of Bhattacharya. So, it is not that something doesn't happen because people have got bad intentions or people lack intentions. Something doesn't happen because situation is not conducive. In insurance industry, for that matter, in any of the financial industry, there used to be 4 distribution channels, only 4 distribution methods. Based on that, all their spread minus burden used to be evaluated. Like in banking, you go for finding out NIM and you find out spread minus burden. Similarly, in insurance also, same situation happens. Only thing, insurance is just opposite of banking. It's not a mirror image. If a bank collapses, first thing customers will want to get back their money. If an insurance industry collapses, the last thing customers will want to get back their money. They will like their liability to be met. Because they pay this much of money and cover this much of liability. So if the money is refunded, what happens? The liability remains exposed. Like that, whatever is the principle of banking, principle of insurance is just its opposite. I can list out 10, 12 such principles where what you do in banking, you must do the opposite in insurance. But unfortunately, our regulators coming from either banking channel or bureaucratic channel, they understand insurance as banking. Insurance is banking 84 to 86%, so long as business is concerned. The maturity business is concerned, but insurance has got other methods for managing itself. Because there is something called implied liability which rules insurance, not the liability. Insurance balance sheet will never balance, unlike banking balance sheet, because insurance liability will be this much, asset will be this much. And this liability has to be historically scaled down by a process. Now even IFRS is struggling how to find out a way to balance the insurance balance sheet. In fact, IFRS 4 is inadequate. That's why they have come for IFRS 22, and they have told 2022 will be the date. Recently, Raman Sahab is here, I think. Mr. Raman, we were in fact attending we were talking in a seminar of accountants. Now they have formed a committee, Parliament has formed a committee of the accountants for finding out the insurance accounting, not adopting the banking accounting. Anyway, that is another story. So the contours of insurance, that insurance is being discovered, still discovered in India. Like a grandfather keeping all the money like Jagannath Kundu and dying, the grandson becomes happy because he gets all the money. So similarly, nothing has been done in insurance, and the present generation of students should be happy that everything else is waiting for them to be done. In fact, India's insurance, as I told you, penetration is very low. World insurance size is about $5 trillion, and India has not yet, if we are to become a superpower, at least we should be world average fast. To be world average, our growth rate should be 100% for next 20 years. Then only we will become world average. If that is the thing for insurance industry, you imagine how much of innovation is necessary, and innovation is almost non-existent at this point of time. 2 points I'll touch. One point is, any finance product becomes valuable provided there is a secondary market. There is a exit route. In insurance, secondary market of insurance has not yet developed in India at all. In USA, the insurance is as good as stock market because they have got a secondary trading of their life assets. So people can just upload it, they can have liquidity. But in India, the insurers, so far, they do not know how to go for secondary market in insurance. In fact, by assignment, something has started, and then LIC found it very dangerous because people may go away because of their inefficiency, because LIC return, when India's return used to be 10%, LIC return used to be 5.5%. So it is almost half of the return required rate of return. So that's why they scuttled it, they stopped the secondary trading in insurance. So another thing, similarly in general insurance, the concept of India's concept of general insurance, the coverage is very much boundary driven. They create a boundary condition, and still then the loss ratios go even beyond 100%. For example, in health insurance, loss ratios are often 135%, 140%. That is because of the inefficiency of the distribution channel. As I told you, I'll finish with this. Distribution channel, there are 4 models. Full service model. Then second is called mutualization model. Third is called, which Sab was talking and all of you are talking, that agent principal model or business correspondent model. And the fourth is provided centered model. World has gone beyond these 4. In fact, ILO says that if you go for micro insurance with a full service model of banking, if you go for a microfinance with full service model of banking, if you go for micro insurance with full service model, the burden will be so much that it will become so costly that either the customer will suffer because he has to pay more, or the company will not survive because its burden will be higher than its freight. So that's why we have a requirement in all financial segment, including pension, we have a requirement of recreating our distribution based on digital inculcation. And in fact, unless we pump in more of technology into the mobile device, or we go for BHIM-like innovation, even BHIM is not, because you see, getting a convenience is one thing, but using that convenience with safety is another thing, and using that convenience sustainably is another thing. So that's why what the insurance industry now at this point requires is that lot of knowledge worker entering into the industry, bringing the global innovations to India safely and steadily. And I tell you, CalPERS, if you would have heard of CalPERS, if you would have heard of AARP, American Association of Retired People, these are just pension funds. We are talking that we are superpower, 5th biggest economy of the world and all that. Do you know AARP can give a small check and purchase India? Their size is that much. CalPERS can give a small check and purchase India and part of China. So this is the size of fund pension funds will manage. And now LIC is managing, the size of fund LIC is managing. For that, manpower is not built to manage that kind of fund. Though banking is still, I'll tell you, well manned. But insurance, contours of insurance is that we need lot of manpower in the insurance industry, and we need lot of manpower and lot of ideas in pension industry. Thank you.